Welcome to sample problem number 5 video. In this video, I will not go over in detail the topics that we have gone through already that has already been covered. There's one new topic here which relates to annuity, and I'll go over that, but the other areas I'll just go briefly through them. Let's start. Cliff Pine, age 66. Right away, what pops? The fact that he's older than 65 years old, right? And his birth year is before 1955. So make the appropriate checkbox on Form 1040. As well as remember to add the additional standard deduction on line 9. Amy Pine, age 44, live at the following address. Both have excellent vision, but Cliff is a bit hard of hearing. During the year, they had the following items of income. Dividends, all qualified dividends. Fidelity Magellan Fund of $950, Century Growth Fund of $700. This is income and it's taxable. Reported on the appropriate line on Form 1040. What line or lines? And is Schedule B required? What about the qualified dividends and capital gain tax worksheet line 12A? Does this need to be done because we do have qualified dividends, right? Cliff won a paddling trip down the Ocoee River. The fair market value of this trip was $450 and he received Form 1099 miss reported in $450 in box 3. So what are your thoughts about this? It should be that this is income, right? And what type of income is this? Let's take a look at Form 1040. Lines 1 through 8 reports different types of income. And line 8B we know is adjusted gross income. Different types of income are reported prior to that. That becomes part of adjusted gross income. Now, is this $450 part of salary, wages, and tips, interest, dividends, IRA distribution, pensions, Social Security, and so forth? Doesn't appear to be so. See line 8A called Adjustments to Income from Schedule 1. Take a look at Schedule 1. It's called Additional Income and Adjustments to Income. So Part 1 of this schedule is additional income, and these different types of income includes taxable refunds, credits, alimony received, and that depends on the date of divorce or separation, as we will see later. Business income, other gains and losses, rental income, from income, unemployment compensation, and line 8, other income. So this appears to be other income. Let's fill that in. Paddling trip for $450. And look at line 9, that's the total, and we will report the total on line 7A of Form 1040. Take a brief look at adjustments to income. This is deductions from AGI. It's part 2 of this schedule. And these different adjustments to income include educator expenses, certain business expenses. All these items are in Chapter 2. In your book, Chapter 2 has a nice list of all of the types of income that will be included as taxable income. Some of these items are very interesting, such as, let's say, gambling winnings and gains from illegal activities. There's also a list of exclusions from gross income. Continuing on, Amy received $6,000 in alimony from her ex-husband, Don Juan DeMarco. Amy's separation agreement with Don was executed in 2015. This year of execution is very important. So $6,000 in alimony received, that's considered income, but would also depends on the year that the divorce was executed. As you see here on this list in your textbook, alimony excluded after 2018, meaning that when the divorce happened after 2018, then it's excluded. But any divorce that occurred before that year, then it's part of income. In this problem, it was executed in 2015. Therefore, we need to report this as income. And where does this go? On Form 1040. We saw this a bit earlier. We saw this a brief moment ago. Remember Schedule 1? Here it is again. So alimony received is an additional income, but it depends on the year. Because this is 2015, we put it here. It's before 2018, so we report it as part of income, which is $6,000 in this problem. So the total is $6,450, and we carry it over to line 7A of Form 1040. Next, Cliff also received the following amounts. Social Security benefits received $14,000. Where is that reported on 1040? Right here, $14,000. We have to determine the portion of that that's taxable. And we know we used the Social Security benefits worksheet for lines 5A and 5B. The $14,000 goes here on line 1. And based on that, we'll determine the Social Security benefits that's taxable. That amount goes on line 18, and line 18 is carried over to line 5B of Form 1040. Another type of income. On March 1st, Cliff began receiving $2,000 per month from an annuity. His life expectancy on that date was 10 years, and Cliff purchased this annuity in 1982 for $60,000. So he received $2,000 per month as income. Is this taxable? It will be taxable. Line 4C is for pensions and annuities. How much is pensions and annuities reported here? And the taxable amount of that pensions and annuities is in 4D. You need to determine the taxable amount. Just like Social Security benefits, you have an amount of benefits and determine the taxable amount. But first, what is 4C? If he receives $2,000 per month for the year, how much is that? Keep in mind that it started on March 1st, so there's only 10 months. 10 months times $2,000 per month for the year is $20,000. Make note of that and report it on here. 4C, $20,000. Now we need to determine the taxable amount of this $20,000. For annuities, there are two methods to determine the amount to exclude from taxable income. One is the simplified method, and the other is the general rule method. And in this formula here, that's the general rule method. We will use it for this sample problem. First, let's understand the formula here. So we have 20,000 of annuities. We need to determine the amount to exclude from it so that we know the taxable amount. And this formula says, take the investment in the contract. What is the investment in the contract? Well, that's how much the contract or the annuity was purchased for, right? $60,000. $60,000 divided by the annual payment times life expectancy. What is the annual payment? That's the amount that the taxpayer received, which is $2,000 per month times 12 months and times 10 years. Which equals 0.25 or 25%. So 25% would be excluded. Let's examine this ratio a little bit closer. So in the numerator, you have investment in the contract. That's how much you are purchasing the annuity for, how much money you put in. And the denominator is how much you get out, the outflow. So the inflow divided by the outflow, or how much you put in as a percentage of how much you can get out. How much you put in as a percentage of how much you could get out. What you get out is the payments that you get each month for 10 years, right? And that comes out to 25%. How much you put in as a percentage of how much you get out. And that is the amount to exclude from taxable income, which is 25% in this case. And 25% times the amount received which we determined was how much? $20,000. It's the $20,000 for the current year that we're doing the tax for, because we get $2,000 per month times 10 months in this particular year. That's $20,000, and 25% of that $20,000 will be excluded from tax. The calculation comes out to $5,000 as the amount to exclude from tax. If $20,000 is the amount of annuities and $5,000 is excluded from tax, $15,000 will be taxable income of this annuity. Last piece of information on the sample problem. Amy receives salary from her job. She's in charge of canoe rentals, and her W-2 is provided by her employer. Box 1 of W-2 is gross wages of $17,500, and Box 4 is federal income taxes withheld. We know this, we've done it a number of times already. Gross income, Box 1 of W-2, we report on line 1 of Form 1040, and the federal income taxes withheld we report as prepayments of tax liability on line 17 of Form 1040. So on here, line 1, you have the W-2 earned income. On line 2, you have City of Atlanta and Wells Fargo interests reported in the appropriate box. On line 3, you have dividends from Fidelity and from 20th Century. Report the appropriate qualified dividends and the ordinary dividends. Line 4, we have annuities, and we just talked about that. Line 5, use the Social Security worksheet to find the taxable amount of Social Security. The Social Security benefits, we know is $14,000. How much of that is taxable? Again, use the Social Security benefits worksheet. Line 7A, we have a couple of additional income reported on Schedule 1, line 9. So carry it over into line 7A here. 7B is the total income. Line 8A is the adjustments to income from Schedule 1, line 22. It's part of Part 2 of Schedule 1. Schedule 1 has two parts, additional income and adjustments to income. Adjustment incomes gets reported or carried over to line 8A to be reported. And 8B is the big line, adjusted gross income. Line 9, we select either the standard deduction or itemized deduction. Since we do not know the itemized deduction, we assume the standard deduction is going to be higher. We have to add in the additional standard deduction. So whatever is the filing status, select the appropriate amount of standard deduction and add in the additional standard deduction. Line 10, we don't have any. Line 11B is the taxable income. Calculate that based on the lines above that. Line 12A is the tax. Because we have qualified dividends, we cannot directly use the taxable income from line 11B to look up the tax in the tax table. We have to use the qualified dividends and capital gains tax worksheet, line 12A. Use that worksheet, obtain the number, and carried it over to line 12A. There are no credits in this sample problem, is there? Calculate line 16 or line 17 from the information given in the sample problem. Calculate line 19 as well as line 20 and line 21A. You should get a refund of $226. And don't forget to sign and date the tax form. Check all of your work and make sure you have Schedule B, the Qualified Dividends and Capital Gains Tax Worksheet, Schedule 1, Social Security Benefits Worksheet,